Good morning, everyone. Thank you for joining us for the Hyperion Fund quarterly webinar. We appreciate you taking the time to be with us. Over the course of the first quarter, we received several questions about how we think about risk management and risk taking in increasingly uncertain environments. Today's discussion is going to center on that topic. In options trading, return tends to get the attention, but for us, risk is where every decision begins. Before we get into that, I'll briefly touch on performance. In the first quarter, Hyperion returned 4.58%. Monthly returns came in at 0.89% in January, 1.23% in February, and 2.4% in March. April was a quieter month with Hyperion returning just 0.14%, bringing year-to-date performance to 4.73%. While performance is always important, what we believe matters equally is understanding how returns are generated and how risk is managed when market conditions shift. At a high level, Hyperion is built around a disciplined multi-strategy approach. The 8 strategies that the fund deploys can generally be defined as either long volatility or market neutral, and we consistently weight the portfolio to be 35% long volatility and 65% market neutral. Our objective is to structure risk intelligently, remain adaptable, and create a repeatable process. To help us do that, joining me today is our Chief Risk Officer, Mark Adams. Mark plays an important role in helping oversee portfolio level risk, scenario analysis, and exposure limits. One of the key principles across the Hyperion Fund strategies is that risk is defined before risk is taken. Mark helps ensure that that process remains consistent and aligned with our broader fund objectives. Mark, glad to have you with us.
Thanks, Tyler. Happy to be here.
So at Hyperion, we often say we do not attempt to predict markets, we structure risk around them. But what does that really mean? So, with our market neutral strategies, we're identifying high probability trades on the edges of the market, while volatility trades are very much using directionality to drive performance. One of the more differentiated parts of our strategy is how we think about forward looking risk, not just current volatility, but what the next 24 to 48 hours and so on could imply for exposure, liquidity, and market behavior. Mark, to help us kick off the conversation, and maybe before we get into some of your thought processes, why do we trade options? What do we like about, or what do you like about options over trading the underlying contracts directly?
Oh, how long do we have? I could sit here and talk about why options are the best trading tool out there, I would argue. It really comes down to the flexibility and the malleability of being able to parse risk exactly how you want. If you, like you say, if you just go along the underlying, you're just pressing a button up or down. You're along for the ride, you're short, you're long. Either that's fine if that's what you want to get. It's cheap, it's easy, but it lacks nuance. It's a much more hammer approach than I would rather have a scalpel. I want to be able to kind of nip and tuck and get in, get out, this kind of thing with options, because the ability to not just parse risk in time, but also positioning and volatility exposure and all these things that go into what an option represents. I find them to be the most, I was bitten by the option bug, oh gosh, almost 30 years ago now. And it's been with me ever since. And I think it's a far, far superior way of trading markets than just directionally alone.
So, and you talk about how you can parse risk using
Mm,
options, and that is how we think about options. But I like to talk about options too, in the sense that I like the way I usually put it is that it can give you many outs to be right, right? You can be right in more than, hey, the market's going to go up, I'm going long, and if it doesn't, I'm
mm.
wrong. There's options in it, and within an option through the time decay curve and everything else that allows you to be right on a trade without necessarily having the perfect forecast or
Right.
perfect prediction. Does that make sense?
It does. One of the fun nuances, I mean, this is before my time in trading, but during the crash of October of 87, if you went long calls before the crash of 87, you actually made money because volatility expanded so much that that drug up the price of your call option versus, and obviously puts exploded in value, of course, but it's that kind of nuance that's a little different than, that if someone says, well, obviously, if you just bought the stock market, you would have lost your shirt. Well, that's not the case with options. Not always. You can get now it's a two-edged sword. You can be wrong in a number of ways. You can be wrong right in time, but wrong in price, or vice versa. But it does allow you to, like you say, not just parse risk, but say I want to have the risk over this time period. And not to jump the gun, get into that 24 to 48 hour kind of thing we mentioned earlier. It's like you look forward, like what's going on in the world right now? What are the known unknowns? What could possibly go wrong? What could go right? And you want to have positioning, and you can say, all right, I want to have positioning around that, or gosh, you know what? I'm going to pull my exposure in closer in time because I don't have exposure to XYZ event that may be coming up. I mean, as you've seen, I mean, we could talk for hours about just the recent since the Iran war headline risk. I mean, even today we see we were down on the day for a moment, and now we're up 65 S&P points. Why? Potential of maybe perhaps that kind of deal, but it's a forever changing thing, and that changes every 5 minutes now as opposed to 24 to 48 hours. But that's where having the option pricing have that risk embedded in it already is important. That's a key thing that I think we can get into and dive into that later.
Well, yeah, you just said a bunch of things that I want to dive
Hmm.
into, and I feel like are super helpful in terms of the things that we think about when we take risk or we manage risk. Um, but maybe to help kind of get us into that. So, Mark, when you start the trading day fresh, whether you have positions on or not, and you're opening up the option chain, what are you kind of looking for? Sorry, let me take that step back. So, if you are looking at the option chain and you're looking to take risk, you're looking to put on risk. What are some of the things that are going through your mind when you open that up and kind of have a clean slate?
Right. The first thing is what's going on in the world. Where are we right now? If it's the Friday before a long weekend like we have coming up, is it a Monday after a volatile weekend? What's the lay of the land right now? Where's volatility? Where are our options reflecting, the unknowns of the world right now? And that's the first step. If all of a sudden you're looking at this and you see pandemonium or lack thereof. We'll take both extremes. If markets are going crazy, all right, what do the options look like compared to that? How wide of a spread can I get if I'm wanting to buy a put spread? Is it, how juiced up are premiums if you're looking to take a credit? How wide are these ranges? How, meaty is the potential trade? And that's just a staring at a screen for 10,000 hours. So you can kind of get a feel for, okay, is this a 2 day trade? This is a 3 days. This is a 2 week trade. What is Mr. Market offering? Conversely, if it's really calm, if you look at it and all of a sudden, hey, maybe wait a minute, the option chain is telling me there may be something going on the horizon or priced as such. It may be, spreads may be very wide. I mean, when I say spread, it's like not just the bid ask spread. I'm talking about like the spread between a potential long put spread, perhaps. If you can get, let's say 300, 400 point wide, 1 by 1 for cheap, or 1 by 2 for not much price, not much money. That kind of tells you, wait a minute, the market is kind of, mispricing, perhaps. I don't want to say the market's wrong, but what happens a lot of times is that markets will often kind of lean one way when they shouldn't, or if in a euphoric market like we've seen, puts can get really cheap really fast. And what we have seen a few times when markets scream higher, those puts have held their value. That's one of those type of tells that tells me, hey, wait a minute, the market really doesn't believe this move. This is the market has gone up. Let's call it 500 points in the last, 3 weeks or whatever. But all of a sudden, it's like, hey, the potential for retracement is there. Maybe not a full retracement, but if over the long weekend, if we get it, if savers start rattling a little more, who knows? Then that could be an issue. But if options are not pricing that risk, then that tells me, all right, let's pare that back. Let's hold back on that. That's that. Not necessarily the risk management, but it's the value. What is are you being properly compensated the time and price risk that you're taking? If that's there, great. If not, that tells you train us horse arms, pull them in, and let's just keep everything short dated.
Yeah, that makes a lot of sense. So, obviously, Mark, we do this all day, every day, and it's very second nature to us. Explain to an investor or to one of our Hyperion Fund investors that isn't in this industry, when the market's breaking all-time highs and you see that VIX creep with it,
Hmm.
and you're saying the market doesn't believe that this move is real or that it's going to persist. What's happening that's making that VIX move up along with the market in reality? What's the actual function that's happening?
Two things can cause that. One, disbelief in, when I say disbelief, if people say, the market's screaming higher, but they're spending money, VIX will rise as option prices rise. Option prices rise because of supply and demand. If people come in and say, a trader walks in and says, hey, I want to, we're up 3% in the course of a few days, but I think there's a high probability of a retracement. I want to go spend money to buy a put. I'm going to pull that and maybe sell a call, something like that. Whatever they're doing, they're betting against the market by doing that. So if that happens, they're putting their money to work. They're going to drive up the prices of puts. That will then in turn drive up the VIX. Conversely, it can also be market up, vol up situation where because the market is screaming higher, call options are being bid up dramatically. That can drive the VIX up sometimes, but then because of a rising VIX, sometimes put call parity can help puts rise in value as well.
Hmm.
That's a great trading environment right there because a lot of times when volatility gets crushed, it's like, all right, there's not a lot of, net premium or, if you're trying to do a spread trade, there's, the tail end of your spread, your short side of it, if you're long, maybe cheap, but you're short, maybe even cheaper, and your spreads get expensive. So that's where you kind of have to, there's a few different ways volatility can really move it. And that's your judgment call at that point. What is the driving factor? And that's just getting in and looking at the actual prices. What is going on in the actual legs of the spread?
Right, right. Yeah, I do like to, because it's a question we get a lot, especially in such a headline-driven world. How do you get the landscape of the world, right? Is it Twitter? Is it your Bloomberg terminal? What's keeping you informed? And I do like to tell people that we don't need to be the most informed people. We're looking at the option chain, and the relevant headlines will filter through to that point to the point where it's relevant to us. That's not always true because, like you
Right.
said, sometimes the option chain is not pricing what you think the risk is. It seems to happen like on a Thursday, Friday. You know you're going to hold risk if you take this trade. You're going to hold risk over the weekend, and so there is that additional, weekend gap risk that the options might not be implying. So, what maybe outside of just looking at the technical activity of the option market or what you see in the market, kind of how are you evaluating what's relevant and what's not um, when there is just so much noise?
Sure. Yeah. You hit on the first two that I love. I mean, Bloomberg is great as being kind of a, it just like any other news source, it's going to pull them all together and give you most of everything. That's great. But then again, that's going through a filter. So that's where Twitter/X, whatever you want to call it, is really good. If you self curate a list of informed, knowledgeable people in a certain space, you can really get a good feel of certain things. Like, I'm not an energy trader per se, but I follow certain people that are. And during this
Hmm.
conflict, they're like, "Oh, well, this is why, and here's the tracking of this boat, and things like that." I need no single person has the time to do all of that, but if you find experts to do that, that's useful. But then getting to the point of the unknown over the weekend, I think that falls back to 5 minutes ago we talked about that value versus risk. That what is that price? Price is just the number on the screen. Here's what it's at. But if the volatility is, declining into a Friday, sometimes that happens where people start shorting volatility because they think, a weekend risk is low. Well, that's maybe in this environment a time to go the opposite way, to then buy that volatility or be conservative. Because if you're not getting properly compensated for the risk that you're going to take, especially the unknown risk, we know kind of the levers that are being pushed left and right. And attack versus this, jawbone that, whatever. But there's always okay, what if? What if all of a sudden X were to happen that you don't know about? That's why you need to really kind of focus on getting into the not necessarily the what's going on, but what's actually going on in the pricing. That's important.
Right. Something you mentioned with where a conducive trading environment, the VIX is increasing, the market's also increasing. That's somewhat illogical, and ultimately, what's driving that is uncertainty. Right? There's uncertainty in the market, and they're trying to capture either manage risk or capture as much of it as they can. Um, Going back to the first quarter a little bit, uncertainty is a good way to put, the market environment of the first quarter. We performed very well for what our fund is designed to do, which is, 10 to 12% a year, regardless of market direction. But if we have a opportunistic market, which the first quarter was, we take advantage. So maybe getting a little more specific into, so we take trades on the I like to say the edges of the market, high probability trades that obviously have to be risk managed, and then we are trading downside directional movement from the S&P 500. But now I'm talking about strategic.
Mhm.
How do you look at those two different trade structures differently in the sense that high probability trades on the edges of
Mhm.
the market, and you have these low, I would call them low probability trades because the market
Right.
doesn't roll over that often. Um, Talk us through that a
Especially in
little bit.
this market. It doesn't seem that when it does, it's fun, but when it doesn't, it really comes down to the relationship between the options, and it's kind of the same answer to two different strategies. Well, one is essentially a credit spreads. You're taking in money because I think a lot of people get lured by the siren song of premium collection. Because if you can sell an option for 50 cents, that's great, but I can double my money and sell it at $1. And then you double my money again, sell it for $2. Well, that's where your novice option trader gets really, you can get themselves into trouble very quickly, because that is a slippery slope there's a graveyard outside the back of the building you're in your background there. I'm sure of a lot of option traders that came and went because they tried to take a little more risk and not understand the potential there. So it's really the option, the kind of relationship between the options. Say you want to have like a call spread or a put spread where it's maybe 100, 150 points wide, call it 15% out of the market, below the market. If that's 30 cents, and like that's okay. But if it's 50, 60, 70 cents, that's where it gets interesting, because it's like there's still like you say, 15, 20% out of the money for the course of like a week. Can the market go down that fast? Of course. It always is a possibility. But it's just like you say, that high probability, it's just really the relationship of the location of that spread, the width of that spread, and the value you can get by selling or buying that spread and taking a credit. So at the end of the day, having long options paired against shorts, I think is critical. I think that is I don't want to say a no-brainer, but it is definitely a very important process to kind of to stick to your knitting there. If you come in and say, I like spread trading, now you're a premium, just straight premium or just straight buying options, you're opening your door up to different risks that you're engaging in at that point. So, I'm a big fan of, singles and doubles. You just, hit a single every time, and you're gonna win the championship if you just make one hit every time you're at the bat. You can be the best player ever. Obviously, it doesn't work that way always, but hey, if you can bat 95%, that's a lot better. Conversely, you think of something like like I always call strategic a gray swan kind of. You want it to kind of make money in the lower frequency, but higher potential probability, higher potential payout of a market sell-off. We've not exactly had a two-way market here in the last month and a half. But earlier in the year, go into last year, you saw that choppiness. So what you kind of do, you kind of put your positioning out there and just call it like I call them bear traps. You put a position on where if the market sells off, something you purchase air quote for free. It can be a free no cost spread to do that, buy one sell two, that type of situation. So you've got that spread, and again the levers are width, position away from the market, and price. So if price is as low as possible, that kind of dictates that. How far out in the future do you want to go? A lot of times like to stagger them, have two or three or even four positions on at one time, expressing a similar idea, but spread out over the course of 2 weeks or so. With that kind of thing, if you ever see a sell off again, and when we do see that sell off again, that's when you need to be primed, ready to take advantage of that. But again, it's really just the relationship between those options. If all of a sudden volatility goes to nothing and those spreads are ultra tight, that tells me I really don't like that position. Let me change up one of the factors. Let me change up the positioning or the time to expiration. Let me move those around, and then you find something that's more attractive. So a lot of factors that are, that you can move, a lot of leverage you can move that you can't with just going long or short.
And I would imagine what keeps you from, selling the $2 option over the 50-cent option is experience, right? If
Mm.
you haven't seen, because so much time passes between these real volatility expansions, right? Like, early 2022 was barely even one. It was really March 2020 was the last,
Yeah.
significant volatility inverted. Um, we always say the market has a short memory. People do too, right? It's easy
Hmm.
to forget what's possible when things really do, when it hits the fan, right?
Yep.
There's a story from a young trader that started his career at one of the premier prop trading firms in the world. And these younger guys, they would start every day by watching the May 2010 flash crash, or April
Oh,
2010,
geez.
excuse me,
Yeah.
because
No,
it's
it's
easy to
May
believe.
6th, 2010. You're right. May
Yeah,
6th.
thank you.
Yeah, yeah, I
It's
remember.
easy to
Yeah.
believe. I remember too, as I was, yeah, at MF Global, one of my first jobs, but
Oh,
it's
geez.
easy to believe that that's not possible unless you
Yeah,
watch it happen. And so
yeah,
that's how I started every morning, is like, look
yeah,
what's possible, even though you haven't seen it in 15 years.
yeah.
And I think that that's, it's tough to say I have the experience and you should rely on that, but there is some truth to that, that
Mhm.
you lived through those things, you experience them, you don't ever want to necessarily experience them on the wrong
Exactly.
side again.
Right. Yeah, because there are times where that $2 option is the best value, but there are most of the time it's not, because you kind of have to go into the situation where you say, all right, looking at what is the high probability of this option, or specifically that spread, going lower, going to zero. What is a high probability trade there? That's where, if it's worth $2, great. Usually it's not. Usually it's going to be cheaper than that, because $2 that's a real option.
And it's easy to talk about what you're good at, right? So the first quarter, like you said, was a two-sided market. We were able to make money on the long ball and the market neutral side, and so we had a great quarter.
Hmm.
Then comes April, right? Market decides to stop, and it's going to go straight up. I think it
Hmm.
finished the month somewhere up between 10 and 11%, S&P 500. Now that transition from a two-sided market to a very much one-sided market, and like you said, that when volatility crushes in those options, you are much closer to the market to be able to get a similar price than you were in March. What makes you say that risk isn't worth it, or that risk is worth it? Or why is that? Because people often don't really understand why we struggle in big up months. And I
But
try to explain, if oftentimes the trade is there, but it's at a risk level that we aren't comfortable with, or sometimes the trade's just not there. But
yeah.
what does that mean? Maybe you can explain that better than I do.
Sure. So I think it really comes down to, what's your goal? A lot of traders will come in and say, I need to make 2% every month. That's what I have to do. This is my forever. This is what I'm going to do. Well, that's the problem. When volatility decreases, what are you going to change? You're going to change either proximity to the market, time, or quantity to get to that. Those are some trade-offs that I would argue that leads you back to that graveyard that we talked about. If you can't find the right trade that gives you decent return without that. And one, having a return bogey, that's dangerous in the first place. You say, I want to find the best trade I can. And if that just means you're going to make 30 bits that month, or 14, or whatever that number is, if you're willing to accept that, because the key is, I want to trade next month too, and the next month after that, and the next month after that, because that may be the 2% month. That may be the month where we get a 2.5% positive. So being able to, look at the market and say, I'm not okay with for the same quantity of premium, for that same price, the same potential return, if I have to compromise significantly on, like you say, proximity to where the market is, or I would argue, something that's even a little more, not as obvious, but it can be more of a problem, time. If you say, normally I'm taking a 1.5 to 2 week trade, and this is now 3 or 4 weeks, that's a different trade, especially in a market like this where things are changing, not necessarily every 5 minutes, but we have a lot of shifting winds that can really change an option you love today. 2 weeks from now may be your worst enemy. So
Right.
finding that kind of that risk balance, and I really think it comes down to, at a certain point, you just have to accept a lower return in a market environment like that. I think that's all there is to it. It's disappointing to hear sometimes, because you want to have a really good month all the time, but if it doesn't work, it doesn't work, because staying in the game is the key.
That makes sense. I want to touch on something you said there, regarding time. So, without going, we're going to lose a lot of people if we start really talking about the time decay curve of options. But how do you think about not just risk but reward when you're looking at you know the duration of the trade? Right? How
Yeah.
far out is it from expiration? And as we know, decay will accelerate as you get closer to that expiration. Are you already, you know, far beyond that curve to where you're in that time decay acceleration when you put on the position? Or how much does that weigh on your decision process?
Yeah, I mean, like you say, not going into it too deeply, but when I started in the business, there was one expiration per month, and that's when you really saw, after the certain month became front month. That's when you saw options start to decay. Now there's expirations every day, et cetera, et cetera. So and you also see, because we have, let's say, some, I don't want to say erratic news flow, but news flow that changes pretty consistently, that time decay, has really, options hold their value a lot longer, so keeping that in mind. So, um, going back to the whole idea of like how far out do you want to go and what is your risk reward for it, that is, because I would argue options hold their value a lot longer than they used to. I think that keeps, certain type of trades are more attractive in that sense. You can
Right.
you can keep expiration, you can keep your time to expiration really short, 2, 3, 5 days. But that also means if you're trading between 1 month or 1 week, 2, 3, 4 weeks, you don't need to go to 4 weeks. You can stay at 1.5. So that kind of sweet spot, because I'd rather stay shorter anyways, especially on a trade where it's like a gray swan type trade. So I want to be close to the market, but not too close. So
Mhm.
if we can stay within a relatively short window like that, that's ideal. That's your sweet spot right there, and options holding their value longer allows it.
Yeah, I can't really imagine, how we would operate with a month one time a month expiration,
Oh my
given that
gosh,
we use every expiration of the week, 5 days a
I
week.
know.
I can't even it's hard to imagine.
Uh, I'm waiting for them to come out with noon expirations. I'm sure it's going to happen at some point. The half day, here this expires at this time. They can do it. They are. I mean, I'm sure they have the technology, so it's happening soon. I'm sure.
Oh, that's, yeah, we'll timestamp that. I hadn't even thought of that. I think you just called it. We'll hear the CME announce that
We'll
soon.
call the CME soon on that one. Yeah.
Um, Mark, kind of uh, last topic here. You mentioned the graveyard behind the board of trade, and that's where the strategies go to die. We plan to stay out of that yard for good.
Mhm.
And part of that is, we talk about defining risk before risk is taken. Not every trade can have absolute defined risk, but it can have a defined plan on how you're going to manage that
Correct.
trade once it's put on. So we know where we're going to reduce, we know where we're going to cut entirely.
Mhm.
You've got that critical level. Kind of walk us through, you put on a trade structure, what are some of the things that you're monitoring and already know, once you put that trade on,
Sure.
these are the things that I know that I have to execute if X happens.
Right. Yeah, I think it goes back to that, price versus volatility. If you have a position on, you have risk, let's say 20% below the market. Yes, the probability of your risk going, your options going in the money is low. It's not zero. But really you have to balance the value, because if you put a position on and maybe it's a credit of, $1. Okay. Is it at $5? Do you like it 5 times as much, or is that a little scarier? That's where you need to then say, all right, if perhaps the price of the option has changed because of market expectations, and now it's worth $1.20, $1.40, $1.50, it's a price against you. But if your priors haven't changed, if volatility is still where you like it, and the news flow isn't different, then maybe that's where you say, all right, I can add to that position. I can trade, I can continue with this trade. But the key is knowing how volatility is changing versus what you thought. If your expectation is, calm because of, you see the news flow and this and that, but if something changes, say, years ago, this is, China flew a drone over Taiwan. Markets freaked out, and obviously we sold off really fast, 2, 3% in minutes and this, that. But that was a new thing. And then it turns out, oh shoot, that was just an accident. Sorry, our fault. Who knows? But either way, that kind of thing can change your priors very quickly. That's when you say, all right, yeah, I don't want to have to reduce risk right now, but I need to, so I'm going to. Yeah, it's that type of thing. When news changes, when events change, when volatility environment changes in a way you're not expecting, that's when okay, even though I said if we're down 2%, I'm going to go ahead and decrease. If it's before that, I'm going to decrease. I'd rather hedge too early than too late. I think that's the key thing, or vice versa. If you've got a long volatility position and it's not making its money in the way you thought, carry that position. Say scale some back if it's not operating in the way you want it to. All right, I got this one wrong. Let's reevaluate. Take money off the table. Take risk off the table.
Yep. I agree with you, Mark. That makes a ton of sense.
Mhm.
I'm going to bring this home here. So in conclusion, markets will always move through different regimes: high volatility, compressed volatility, trend driven markets, range bound markets. And like we talked a lot about, just periods of uncertainty where you're not sure where the market's going to go. But what should remain constant is the discipline behind how risk is defined, measured, and deployed. Our focus continues to be on building a repeatable and durable process while maintaining controlled downside. That risk first approach is central to how we think about protecting capital, managing drawdowns, and generating long term returns through multiple environments. I also want to thank Mark for joining today and sharing perspective around how we think about the portfolio. That oversight and discipline are a critical part of what makes our process durable. Um, Thank you, everyone, to our investors and partners. Thank you, as always, for your continued trust and support. We appreciate your time today, and we look forward to continuing the conversation in the months ahead. Have a great day, everybody.